In 2004, black homeownership in America reached its peak at 49.1%. It was a milestone that seemed impossible just decades earlier. Black families were finally building wealth, putting down roots, and claiming their piece of the American dream. Banks were lending, neighborhoods were thriving, and the gap between black and white homeownership was slowly narrowing. Then 2008 happened, and everything collapsed. By 2019, black homeownership had plummeted to 40.6%, the lowest it had been in over 50 years, nearly a decade after the housing crisis. While white families recovered and even surpassed their previous homeownership rates, black families remained trapped in a crater they didn't create. Today, in 2025, the numbers have barely budged. The crash destroyed black wealth on a scale not seen since the Great Depression, and the recovery never came. This is the story of how it happened, why it happened to black families disproportionately, and why nearly 2 decades later, the damage remains unrepaired. The setup: subprime loans targeted black neighborhoods. The housing crisis didn't impact all Americans equally. It was designed, whether intentionally or not, to devastate black and Latino communities specifically, and the weapon of choice was the subprime mortgage. In the early 2000s, banks were hungry for profits. They'd exhausted their pool of qualified prime borrowers, people with good credit, stable income, and 20% down payments. So they turned to riskier markets. They created subprime loans, mortgages with higher interest rates, adjustable rates, balloon payments, and predatory terms designed to extract maximum profit from borrowers who had fewer options. These loans were marketed aggressively in black neighborhoods. Mortgage brokers set up offices in predominantly black areas. They advertised on black radio stations. They went to black churches. They promised homeownership to families who had been locked out for generations by redlining, discrimination, and lack of access to capital. The pitch was simple: you can afford this house. What they didn't explain clearly was how adjustable-rate mortgages started with low monthly payments that would skyrocket after a few years. Interest-only loans meant you were never actually paying down the principal. Balloon payments required massive lump sums that most families couldn't afford. Prepayment penalties trapped borrowers in bad loans even when they tried to refinance. Black families, eager to build wealth and escape renting, signed on. They trusted the bankers who told them they qualified. They believed the appraisers who said their homes would appreciate in value. They took the loans, moved into homes, and started building what they thought would be generational wealth. But the truth was darker. Studies later revealed that black borrowers were systematically steered towards subprime loans, even when they qualified for prime mortgages. A 2006 study found that high-income black borrowers were more likely to receive subprime loans than low-income white borrowers. The issue wasn't creditworthiness, it was race. Banks knew these loans were toxic. Internal emails later revealed that lenders referred to subprime borrowers as mud people and the loans as ghetto loans. They knew the terms were unsustainable. They knew foreclosures were inevitable, but they didn't care because they weren't holding the risk. They were bundling these mortgages into securities and selling them to investors, making their profits up front while passing the risk to others. By 2007, over 53% of black homeowners had subprime mortgages compared to just 17% of white homeowners. The bomb was planted. It was only a matter of time before it exploded. The crash, foreclosures, devastate black wealth. When the housing market collapsed in 2008, it collapsed on black families first and hardest. The adjustable-rate mortgages reset. Monthly payments doubled or tripled overnight. Families who could afford $1,200 a month suddenly owed $3,000. They couldn't pay, and the banks foreclosed. Entire black neighborhoods were wiped out. Streets that had been filled with families turned into ghost towns, lined with foreclosure signs. In Detroit, Cleveland, Atlanta, Las Vegas, Phoenix, and countless other cities, black homeownership evaporated. One study found that between 2005 and 2009, approximately 8% of black families lost their homes to foreclosure, compared to 4.5% of white families. But the numbers don't capture the devastation. Homeownership was how black families built wealth. For most, their home was their only significant asset. It represented decades of saving, sacrifice, and hope. When those homes were foreclosed, it wasn't just a house that was lost. It was retirement savings. It was college funds for children. It was inheritance for the next generation. It was stability, security, and dignity. A family that bought a home in 2005 for $200,000 watched its value drop to $100,000 or less by 2010. They owed more than the house was worth. They were underwater, trapped in mortgages they couldn't afford on properties they couldn't sell. Some tried to hang on, draining savings, skipping meals, working extra jobs. But eventually the math didn't work. They missed payments. The foreclosure process began, and the banks took everything. The emotional toll was crushing. Parents explained to their children why they had to move. Families packed belongings into boxes and watched strangers change the locks on homes they'd thought they'd own forever. The shame was unbearable. The sense of failure, even though the failure wasn't theirs, was overwhelming. And while black families lost their homes, the banks that had sold them predatory loans got bailouts. The government pumped billions into rescuing financial institutions deemed too big to fail. But the families losing their homes, they got nothing. No bailouts, no loan modifications that actually worked, no accountability for the institutions that had targeted them. Countrywide Financial, one of the worst offenders, settled with the Department of Justice for $335 million after being accused of discriminating against Black and Latino borrowers. Wells Fargo paid $175 million to settle similar charges, but these settlements came years too late and amounted to pennies compared to the wealth extracted and destroyed. The banks survived, black homeownership didn't. The wealth gap exploded. Homeownership is the primary way American families build wealth. For white families, even those who lost homes in the crisis eventually recovered because they had other assets, family wealth to fall back on, inheritances, and access to capital to buy again when prices dropped. Black families had none of that. The median white family has roughly 10 times the wealth of the median black family. When black families lost their homes, they lost everything. There was no safety net, no generational wealth passed down from grandparents, no family able to loan money for a down payment on a new house. The foreclosure crisis didn't just set black families back a few years, it erased decades of progress. By 2016, the median wealth of black families had fallen to $17,600 compared to $171,000 for white families. The gap hadn't just widened, it had become a chasm, and most of that gap was attributable to homeownership disparities. While white families who lost homes in the crash were able to buy again when the market bottomed out, black families couldn't. They didn't have the credit. The foreclosure destroyed their credit scores. They didn't have the savings. The foreclosure took whatever equity they'd built. They didn't have the income. The recession cost millions of black workers their jobs, and they were the last to be rehired when the economy recovered. So when housing prices started climbing again after 2012, black families watched from the sidelines. They watched as investors, many of them wealthy and white, bought up foreclosed properties at bargain prices and turned them into rentals. The homes that black families had been forced out of became investment properties generating wealth for others. Today, corporate landlords own massive portfolios of single-family homes in black neighborhoods, extracting rent from families who would have been homeowners if the crisis hadn't destroyed their opportunity. The wealth that should have stayed in black communities is now flowing to Wall Street. Barriers to recovery. Why black home ownership never bounced back. The crash ended. The economy recovered, and yet black home ownership rates remain depressed. Why? Because every barrier that existed before the crisis was reinforced after it. First, credit requirements tightened. After the crisis, banks became extremely cautious. They stopped offering the predatory subprime loans, which was good, but they also made it nearly impossible for anyone without perfect credit to get a mortgage. Black families, many of whom had foreclosures or bankruptcies on their records from the crisis, couldn't qualify. Second, down payment requirements increased. Banks started requiring 10%, 15%, even 20% down payments. For a $200,000 home, that's $40,000 in cash. Black families, having lost their wealth in the crisis, didn't have that kind of money saved. White families could borrow from parents or grandparents. Black families couldn't. Third, income stagnation hit black workers hardest. The jobs that returned after the recession were often lower paying, less stable, and offered fewer benefits than the jobs that were lost. Black unemployment remained double that of white unemployment. The income needed to qualify for mortgages was harder to achieve and maintain. Fourth, student loan debt exploded. Black college graduates carry significantly more student debt than white graduates. This debt crushes their debt-to-income ratios, making it harder to qualify for mortgages even when they have good jobs and decent credit. Fifth, appraisal discrimination continued. Studies show that homes in black neighborhoods are consistently appraised for less than comparable homes in white neighborhoods. This means black families build less equity even when they do manage to buy. It also means they can't borrow as much because the appraised value determines the loan amount. Sixth, the loss of black-owned banks and community lenders reduced access to capital. These institutions, which had historically served black borrowers overlooked by mainstream banks, were devastated by the crisis. Many closed. The ones that survived became more conservative. The lending ecosystem that had enabled black homeownership, flawed as it was, largely disappeared. And finally, investor competition priced black families out. As mentioned earlier, corporate investors swooped in after the crash, buying properties with cash and turning them into rentals. They drove up prices, outbid individual buyers, and reduced the available inventory of affordable homes. Black families trying to buy found themselves competing against hedge funds with unlimited capital. The psychological damage, a generation traumatized. Beyond the economics, the housing crisis inflicted psychological damage on black communities that's rarely discussed. An entire generation watched their parents lose their homes. They saw the shame, the stress, the tears. They learned that homeownership, the cornerstone of the American dream, was a trap. Young black adults today are deeply skeptical of homeownership. They saw what it did to their families. They're choosing to rent longer, save more cautiously, avoid debt more aggressively. Some of this is financially prudent, but some of it is trauma, fear masquerading as wisdom. Homeownership rates among millennials overall are lower than previous generations at the same age, but the gap is even more pronounced for black millennials. They're buying later, if at all. And when they do buy, they're buying smaller, cheaper homes in less desirable areas because that's all they can afford. The dream of homeownership, which had motivated previous generations of black families to sacrifice and save, has been replaced with cynicism. Why buy when the system is rigged? Why trust banks that targeted your parents with predatory loans? Why invest in a home when the next recession could take it away? This psychological shift has long-term consequences. If a generation opts out of home ownership, they opt out of the primary wealth-building tool available to them. The wealth gap doesn't just persist, it grows, where we are now. The numbers don't lie. As of 2024, black home ownership sits at approximately 45%, nearly 5 percentage points below its 2004 peak. White home ownership, meanwhile, has recovered to around 74%. The gap between black and white home ownership is now wider than it was in 1960, before the Fair Housing Act. Think about that. Despite decades of civil rights legislation, despite fair lending laws, despite increased awareness of discrimination, the homeownership gap has grown. The 2008 crisis didn't just pause progress, it reversed it, and it's not getting better. New obstacles keep emerging. Rising interest rates in 2022 and 2023 made mortgages more expensive. Inflation reduced purchasing power. Zoning laws in desirable areas keep housing supply limited and prices high. Gentrification pushes black families out of neighborhoods they've lived in for generations. Meanwhile, the structures that enabled the crisis remain largely intact. Banks still target communities of color with higher-cost financial products. Discrimination in lending, though illegal, persists in subtler forms. The government programs designed to increase homeownership accessibility are chronically underfunded and underutilized in black communities. The path forward, what would real recovery look like? Fixing this requires more than time. It requires intentional policy intervention. It requires reparations, though that word makes many uncomfortable, because what happened to black homeownership wasn't an accident. It was a targeted extraction of wealth that demands targeted restoration. Real recovery would include down payment assistance programs specifically for black families who lost homes in the crisis. It would include community land trusts that take homes off the speculative market and ensure long-term affordability. It would include stricter enforcement of fair lending laws and meaningful penalties for banks that discriminate. It would include reforming appraisal practices to eliminate racial bias in home valuations. It would include investment in black neighborhoods, infrastructure, schools, parks, services that make them desirable places to live and raise property values for homeowners. It would include student loan forgiveness to free up income for mortgages. It would include protecting renters from corporate landlords who exploit them while preventing them from building equity. But most of all, it would require acknowledging what happened, naming it, not as a market correction or a financial crisis, but as what it was, the largest destruction of black wealth in modern American history. A targeted assault on black families' financial futures enabled by predatory institutions and sanctioned by government inaction. Until we call it what it was, we can't fix what it broke, and black homeownership will remain where it is, crashed, stranded, and waiting for a recovery that never comes.